Okay, now Instagram Live is working. All right, we are cooking with gas now. All righty. Good morning, good evening, good afternoon, depending on where you might be in the country or in the world. Thank you so much for being here. I greatly appreciate it. Forgive my eyes for darting about. There's lots going about in my dashboard for what I'm looking at here. So forgive me. I am fully with you. Morning, John. Good morning, Ia. Welcome. Thank you so much for being here. You may hear me interacting with my partner in crime, Abdullah Mazar. He's our P&G marketing manager, and he has a great responsibility for making sure that these things go over swimmingly. So I may stop the action at certain points and say, Abdullah, what's going on here? So just forgive that, and thank you so much for being with us, Abdullah. Let's just jump in. Abdullah, is there a way to see who's in attendance? Oh, yeah, I can see it here. I can see the 5 at the top. So okay. Hey, Daria, welcome. Yeah, and if you are here, I can't see exactly who's in the audience, but if you could just say hello in the chat and let me know that you're here, it'll make a difference. So thank you for that. And we're going to just jump right in, everybody. Let's get right to it. Just for those of you who may not know me or be familiar with me, my name is Omari Kamal. I am the founder and CEO of P&G Advisors. P&G stands for Profit and Growth. And if you want to check us out online, you can check us out at that domain name. That's profitandgrowth.com. So we are bookkeepers, tax advisors, and small business consultants. The emphasis is on small business consultants because even though we start with basic bookkeeping and tax planning, we view those two things as just means to an end. What we really are about is what our name would suggest. We're about that our small business clients will be profitable and that they grow. And everything you want to know about us is included in that short statement. We are all about your profitability. We're all about your growth. And in this webinar and in future webinars, you're going to get into the world of how it is that we do that. And we promise that for our clients. Hey, Lisa, welcome. You're going to get into how we do that and how we promise that for our clients. And that's what we're really all about. So yes, we believe that. And again, we'll get way more into why this is the case. But we believe that a solid accounting apparatus is the beginning phase of you being able to build a business that effectively scales. We believe that profit just isn't and can't be some afterthought. It's something that we have to plan for. See, most small business owners run their businesses like, hey, look, I know I need to make money. I know I need to spend money in order to make money. I understand revenues, expenses, profits, losses, assets, and liabilities. But what very, very few small business clients understand is this concept of value. How do I build something that is of value? How do I turn my small business from this passion, from this thing that I'm really good at, into something that has real ongoing value? And the key to that is profit. And again, we don't come to profit as an afterthought, like we cross our fingers and hope we're profitable at the end of a month or a quarter or what have you. It's a crazy way to run a business. We plan for profits, and there's some unique and distinct mechanisms that we offer to our clients that allow them to plan for profits as opposed to just falling into profits. And then likewise, once they are profitable, developing a framework that helps them to understand what to do with those profits and how to effectively invest in themselves in order to have their businesses really grow. Speaking of which, before I get into the webinar and the presentation, let me just give you, again, those of you who are not familiar with me, a little bit of background. So I told you about what we do as a company, but let me just share with you a bit for how we got there. So how we got there was this. So right out of college, I was at that time what was called a registered rep. A registered rep is a fancy word for a stockbroker. So I sold investments for the first several years of my career. And there's lots that I can share with you about the adventure that was. But I learned a lot, and it was a great experience for me. And I did really well at it. And there was a point at which I was meeting with a small business client, and I really like dealing with small business clients. There are all different types of clients that financial advisors have, and we sort of put them in the groups. There's a distinct experience that comes with working with school teachers, for example, and a distinct experience that goes with doing investment advice for firefighters, for example, or professionals or doctors. My personal favorite was small business owners. I loved working with small business owners. And if you're a small business owner, you can probably understand what I'm about to say. And what I'm about to say is that uh, working with small business owners can be challenging, because what small business owners don't often understand is how to distinguish between when it's appropriate to invest in certain paper products like stocks, bonds, mutual funds, and when it's appropriate to invest in themselves. And that was a challenge that I had, even though I really like working with small business owners, because they seem to be just great, affable, agreeable people. Just enjoy, for some reason or other, I just enjoy being around them. But the challenge that I ran into was helping them to understand, like, okay, if I have X amount of money, how do I determine whether I should invest this in stocks, bonds, mutual funds, real estate, what have you, or when I should invest in, say, my own business, and ultimately what that looks like. And how it all came to a fore was, there was a point where I was meeting with this one small business owner who I was really excited to do business with. And I'm laying out my whole investment presentation to him. And he's sitting there nodding politely. And he at some point in the presentation, he stops me and he says, "Omari." I said, "Yeah." He says, I want to do everything you're telling me to do." And I said, "Okay, well, let's go." He said, "But hold on, I have a question for you." I said, "What?" He says, uh, "My question is this: how can I have someone, and I want to do everything you're telling me to do, but with that, I want to find out how I can have someone who can do for me what you're doing for these other companies." And I'm confused. And I said, "Well, what do you mean? I don't understand what you mean by that." He says, "Well, look, we're talking about retiring comfortably. We're talking about sending my kids to college. We're talking about leaving a legacy. And I want to do all that. And I get what you're saying in terms of how investments are going to make that kind of a difference for me and my future and my family." He says, "But aren't we really just talking about me taking my money and investing it in these other companies?" And I said, "Well, yeah, I suppose so. That's fundamentally what an investment is. You're taking money and you're buying pieces or stock in this other company." He says, "Well, look, that's fine. I can see the power and the veracity in investing in these companies. However, I own a business and I see myself as my own best investment. So how can I get somebody like you to help me raise money for my business? Or more than that, how can I invest in myself, my own best investment, or at the very minimum, look at myself in the same way that I'm looking at these other companies that you're providing me all this great analysis for?" And to be honest with you, everybody, I was stumped. I didn't have a great answer for him. I gave him some pat answer that they train us in investment advisor school to give people. And he kind of gave me this look as if to suggest that was a BS answer. And I know it was a BS answer, right? But that, the little things that happen with us throughout life that just really stick with us. They don't have to be necessarily significant, like huge monumental things. But this was a big deal for me. And I spent the next however many years just toiling back and forth with that question. I ended up leaving investment advice. I went to work in public accounting for a number of years. I went from public accounting to working in private equity. I worked in legal cannabis for a while, back when it was first boards and was just being legalized for medical purposes, and then shortly after that, it was legalized for recreational purposes. And I got to be a part of a huge amount of growth in that space. If you're not familiar, so on one hand, you have people who had been operating in what we call the discrete market, which just means the formerly illegal market. And then you had other people, investors who wanted to get into the market. And we were the group that was offering transparency into that. So we had people that we were representing as a contract CFO and keeping their books and giving them financial advice. And we had other people who wanted to invest in those companies. And so our business was to pair the two together. Now, I learned a lot. It's a great field. I got to be a part of a tremendous amount of growth. At one point or another, cannabis was creating more jobs than manufacturing, government, and distribution combined. And I got to see, and again, be a part of a lot of that growth. And the problem was this, and again, nothing against any of you all who use the product, right? But I didn't use the product. That was just my thing. And everybody around me was having way more fun than I was, as you can imagine. And so that was one part. But another part was, I had another thought in mind. I mean, at the end of the day, I'm just a kid from the south side of Chicago, and I have this sort of vision. I've had this vision for a long time of, like, wow, what would it look like? And if you're from Chicago, you know what I'm talking about. Like, what would it look like if the south side of Chicago looked like the north side of Chicago? What would it look like if the west side of Chicago looked like the suburbs? of Chicago. And just for some reason or other, this is a nagging thought in my mind. And when I got to be a part of all this growth, I couldn't help but think about some of these businesses that I grew up patronizing as a kid, and some of these retail, industrial, commercial corridors that I would walk down as a kid that are completely blighted now. Like, what would it look like if if those areas had the support that I was providing to these other companies that had all of this investment potential behind it? And I got into I asked myself this question: what would it take to empower small business owners that were looking to set up in the inner cities of Chicago, New York, LA, Atlanta, across the country? And I asked this question, like, what would it take? What if these small businesses like Mike's Grocery, who I grew up going to as a kid, or my local barber, or the local small manufacturer in my neighborhood, had the same types of resources that I was providing to these other companies as in the private equity space that I was working in? And I got into this argument with myself, and I said, well, no, there's no way that we could provide those types of services to these companies, because there's no value in these areas. There's no business potential in these areas. But hold on, I say, but there's still good people who are spending their hard-earned dollars in the local Osco, or in the local gas stations, in the local laundromat. Like, well, what clearly there's money that's circulating in these areas. Why can't thriving businesses make it in these areas? And I said, well, no, there's no way, because look at the conditions, look at the crime, look at the businesses aren't sexy like some of the .coms or these cannabis related companies that I'm representing. And ultimately, I came to a conclusion. I said, you know what? This is it. There's value in these communities. It's just that the people who are in these communities, who would otherwise be entrepreneurs, they haven't been taught entrepreneurship. They haven't been taught how to be producers yet. And if I could teach them that, that'd be great. And initially, it was just an experiment. It was a thought. I was fully prepared to fail at this. And we started in 2017. And would you know, we found some people who actually got it. We found some folks who really understood what it is to grow in value, what it is to expand, what it is to truly scale, as opposed to just grow. And we'll get into the distinction a little later. But also who really wanted to create jobs and opportunities in what I'm going to call really boring businesses. A lot of the business, if you watch Shark Tank, or you watch The Profit, or you show up to an angel investor event, you're going to hear these like really sexy ideas, these SaaS companies, these new .coms, if you will, these new applications they're receiving large amounts of funding for, these great new ideas. And don't get me wrong, there's a place for those, and I champion those types of new ideas and new businesses that are coming out each and every day. But I believe in what our business is primarily targeted around is helping retail, manufacturing, services, the trades, the contracting space, these tried and true businesses that aren't necessarily very sexy, but still we believe have a tremendous amount of profit potential to them, and likewise a tremendous amount of value for people that aren't necessarily in touch with the next best thing in the marketplace today. We believe that there's a tremendous amount of wealth to be created in common, everyday bedroom communities in Chicago and around the country. And the conversation that we're about to have today is specifically about that particular subject, and about the 8 key drivers of value in your company. So without any further ado, and before we get into this, everybody, I just want to say, um, let me see, just to make sure this works. Yeah, there we go. I just want to say that if you have a question, feel free to raise your hand, or put a comment in the chat. I'm still a little new to, let's see here. Okay, let me remove Abdullah. There we are. I'm still a little new to StreamYard, so bear with me. I may need to poke around a little bit. But if you have a question, or if you have something you'd like to say, a comment, feel free, just raise your hand. I can answer your question in the chat, or I believe I can actually bring you into the uh, the 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 chat here, and we can have a one-to-one conversation. I like these things to be very organic and natural and real. I'm committed that it be useful and engaging for you. So for the time that you have with us, and really thank you again for being here. I know you had a lot of choices about where you could have been today, and you chose to be here. So thank you for being here. So I want this time to be valuable for you. So I invite you to use this. If you hear something that stands out to you, that that makes a difference, or you have a question, please don't leave the session today without getting your question answered. Okay. So what this webinar is about the eight things that drive your company value. Okay, so let's just dig into it. Now, by the way, this is the value builder system that we're about to go over. Let me just say a little bit about that. Okay, so what's the value builder system? The value builder system is based on a book that is authored by a gentleman named John Warlow. It's called Build to Sell. There are 3 books that we buy each of our clients. The first book is called Profit First by a guy named Mike McCallowicz. The second book is called Built to Sell by John Warlow, and the third book is called Traction by Gino Wickman. Now, I am in the process of authoring a 4th book called Business K: How to Turn Your Business into the Best Investment That You've Ever Made. And just like we just talked about, and Business K is sort of a play on the word 401k. So many of you all are familiar with the 401k, tried and true retirement plan. And what we do is challenge this notion that the 401k plan is the central sort of monumental, almighty retirement vehicle, the best investment that you can make. We challenge that, and we challenge really that any paper investment is the best investment you'll make. We even challenge the fact that real estate is the best. You hear that a lot. Oh, real estate is the best investment you'll ever make. We suggest that the best investment that you'll ever make, just like that, just like the gift that old client gave me years and years ago, we suggest that the best investment that you'll ever make is you. You are the best investment you'll ever make. And fortunately or unfortunately, given the times that we're in now here in the United States and really around the world, there aren't many jobs that you can get. They're going to help you keep head and nose above water financially. So entrepreneurship, as we go, is becoming less and less of an option. You have to do it if you hope to not make any uncomfortable sacrifices in the course of your life. You're going to have a business, and you're going to have to get your hands on the levers and dials of how to have that business go, and at a very minimum to complement the money that you're getting from your 9-to-5. But even if you don't have a 9-to-5, again, to grow that business, to scale that business to the point to where not only is it providing for your basic needs, but it has a life of its own. And you are in a position where you work because you want to, not because you have to. That's our goal for each and every one of our clients. So again, our advisory methodology is we're basic. We do bookkeeping, we do tax planning and preparation work, but we do those things in order to have honest conversations with our small business owner clients about, hey, what's your end game? What do you want your business to do for you? Like that business owner client shared with me years and years ago. How do you look at your business in such a way that you're clearer about when your freedom point is going to be? We don't like using the word retirement too much. We find that a lot of people in and around our generation don't retire in the way, or don't even aspire to retire in the way that maybe our parents or grandparents did. Mostly what we want is financial freedom. Like, where's that point where I'm working again because I want to, not because I have to? Where's that point where the risk is off of me as the CEO founder and onto the business? And likewise, I'm able to step back, maybe promote myself to chairman of the board, maybe start to operate in a true CEO capacity, maybe to step away completely and to sell the business. But either way, I'm out of the business. I've captured the value that's there, and I'm moving on. So again, Profit First by Mike McCallowicz is the first book we buy for our clients. The second book is Built to Sell by John Warlow, which I'm going to get into in just a moment, and it's going to be the subject of our webinar today. And the third book is Traction by Gino Wickman. So again, we're writing a book called Business K, which is going to encapsulate the best of all of those books. So you'll only have to read one book if you work with us in a few months. But for now, Profit First, Built to Sell, and Traction. And what we say is that Profit First is a profound methodology because it teaches you that profit isn't some event. It's not a matter of happenstance. It's not something that we hope or pray for. We plan for it. We take our profits first, and we take our taxes first, and we pay ourselves first, and then we run our business on what's left, and that's our OPEX budget. And it's a simple but very profound methodology, which we'll cover in future sessions. From there, we go into Build to Sell, which is the book that supports the value builder system that we're going to go over today. And what Build to Sell suggests is that once you're profitable, once you've figured out a way to become profitable on a predictable, reliable basis, now the question is, how do you parlay that profit into value? How do you understand your business from the context of value? As a small business owner, many of you understand, or small business owners, many of you understand revenue. You understand expenses. You understand profits, losses. You understand assets, liabilities, and equity. But what very, very few small business owners understand in our estimation is this concept of value. And how do I build value? And how do I put myself in a situation where if I need to sell, I can sell? A lot of our clients at this point say, well, I never want to sell my business. Well, I don't care what you want. Exiting your business is not an optional thing. You are going to exit at some point or another. Now, I don't care what that exit looks like. If you're going to sell or give the business to your kids, hand it over to them. And I know many of you are saying, yeah, that's what I'm going to do. I'm going to give it over to the kids. Well, let me just tell you, that doesn't happen in 99% of instances, even with rather large companies. For a session that we can do a whole webinar on, most entrepreneurs' kids don't want the businesses. And if I'm being honest, and I want to get off on a tangent here, but if being honest, it's a lot of you all's fault, right? We can get into why that is, but suffice it to say, the numbers bear out the truth of this thing. Most entrepreneurs' kids don't want to operate in a business. In some instances they do, but for the most part they don't. But if you give it to the kids, I'm fine with that. If you sell it to the kids, I'm perfectly okay with that. But that's one option of several that you need to know about. You can obviously sell it all outright. You could sell it based on terms. You can hand it over to your staff or sell it to the staff. You can hire a CEO, promote yourself to chairman of the board. I don't care what you do or how you exit. All I care about is that you have a plan to capture your value. The biggest things, or one of the biggest things that broke my heart as a financial advisor and breaks my heart to this day, is to see small business owners who haven't planned for their exit, who haven't planned for their succession well enough, and their businesses shutter, their businesses close the doors, worthless. And millions, literally millions and millions of dollars, tens in some instances, hundreds of millions of dollars gets wiped away as if it never existed, just because the owner hadn't taken the time to educate themselves on some basic principles for what it takes to have these businesses rely less on them and more on the systems and the processes that have the business really be sustainable. So anyway, that's what we're going to get into today. And again, in a later module, maybe a later webinar, we're going to get into the traction methodology. And when I say traction, I mean, I'm talking about there's a really cool book called Traction by Gino Wickman. There are actually 3 books that I tend to recommend to people. They're Traction by Gino Wickman. They all kind of say the same thing. There's Scaling Up by Vern Harnish. There's Get Scalable by Ryan Dice. They have some important nuances. If you're a reader and you want to read all 3, read all 3. They have some important nuances. They give you some interesting distinctions about the same set of constructs, but they're all really, really powerful, helping you get from profitability to real value, such that the systems, the core systems or operating systems that you need to be in place are in fact in place. So again, the business relies less on you than it does on the business. So anyway, that's enough of our introduction. Thank you guys for listening and hearing all that. But that gives you the world of not only who we are, where we come from, our origin story, but also a little for what we're going to get into today, because the program that's connected to the book Build to Sell is what's called the Value Builder System. And I'm going to get into this and talk to you a little for how the value builder process works and who we are and what we believe as certified value builder consultants. So the first person I want to talk to you about is this person, Stephanie Breedlove. And this will give you a good indication of the first concept that I want to get into about the value builder system. So Stephanie Breedlove is the founder of Breedlove and Associates. And when she started Breedlove Associates, she didn't realize how complicated it was to add a nanny to payroll. And this is, by the way, this is her business. She runs a nanny staffing business. So if you know anything about nannies, hiring nannies. There's a lot to it. There's some complicated tax stuff that goes along to it. There's some employee management issues. A lot of nannies have green cards and they come from overseas, and it really does take something to um, to put those people in place. And she started basically a staffing agency for nannies, and it was going really well for quite some time. And if Stephanie and her advisor had been focusing exclusively on manager metrics like revenue, sales, profits, like we were talking about, she would have sold, and because she built her business to a point where she was in a position where she could sell it. But she was focused on owner metrics. And I'm going to get into why that is and how that is in just a moment. So when Stephanie hit $30,000 a month in her business, she quit her job. She was working at Accenture. Most of you all will know, formerly Arthur Andersen, and devoted herself completely to Breedlove and Associates. And to grow, she had this choice. Either she could sell to more existing customers, or she could stick with her niche of parents with a nanny. Okay. So now most experts would suggest to you that it's much easier to sell more to existing customers. And they're right, it is easier. But what's rare, what's often easier rarely makes the business more valuable. So what Breedlove decided to do was to stick to her niche and find more parents who needed to pay their nanny. So, and because she had this sort of niche here with nannies and with parents who appeal to nannies, but she decided to stick with parents who needed to pay nanny. And so, and what she did was she ended up laying the foundation for a more valuable business, because she knew that she had this point of differentiation, and she kept working to grow the company. And after 25 years in the business, she built it to $9 million in revenue from that $30,000 a month, and she had over 10,000 customers. So now keep in mind, after 25 years, Stephanie's kids were gone, and she wanted to do something else. So she decided to sell the business. So she discovered a company called care.com. Now, care.com is a company that gives you these lists of 5-star rated nannies and babysitters and your local area code. And at the time, care.com had 7 million parents who were subscribers. And so she went on care.com, went to them rather, and said that all the 7 million subscribers needed to pay their babysitter, their nanny. We can make this easy for you. She said, look, if 1% of your customers buy my payroll service, that's 70,000 customers. That's a business 7 times what we have right now. And it's taken us 25 years to get there. And you could get to $70 million overnight. That's 1%. Now imagine, what if you got 2% or 3%? So ultimately, Stephanie Breedlove sold her $9 million annual revenue company for $54 million. Okay. So just hold that thought for a minute and really look for yourself, like, what could that mean? What could that look like for you inside of your business? And what are the many options? Remember, I said, I don't care what what way you exit your business, but I just want you just to settle in for yourself right now that there's a plethora of ways and options and strategies and buyers for your business. And I'm not saying you need to sell today or tomorrow or next year or 5 years from now, 10 years from now. All I'm saying is just start to get your head around what your company could be worth if you could really begin to identify who the best buyer was. If I talked to Stephanie about buying when she first, or selling her company when she first hit $30,000 a month, or even when she broke the $1 million mark, or certainly the $9 million mark, she couldn't have known what the options would be. But just to be open to it left her open to this strategic buyer who was willing to pay her 4 times what she was earning in annual revenue, 5 times, 6 times actually. So with that said, consider Warren Buffett. Okay, so investors from Warren Buffett on down, what do they look for? They look for companies with a deep and competitive, what they call moat. And imagine a castle with a moat around it. What's the purpose of a moat? The purpose of a moat is to keep attackers away. Another word for it in business is called niche. They have a very deep and broad niche. And so when you have a differentiated product or service, we call that monopoly of control. So in Stephanie's case, she was focused on her financial performance, but her primary goal was boosting the value of her business. So she also focused on the other 7 drivers that you see there. And I'll go through these in just a moment, but well, I'll go through them now. So financial performance, what do you have? Financial performance, what we were talking about before, that's your profit. And not only your profit, but the strength of your financial systems and the growth of your financial growth. This is what we specialize in, really helping our clients to enhance and grow their financial performance. But we also want to talk them through and walk with them through these other key drivers as well. Monopoly of control is what we're talking about now. Stephanie Breedlove has this monopoly of control that was very deep and unique to the world of being a nanny. Now, there's this other factor, other driver of value called Switzerland structure. Switzerland structure is based on this notion of Switzerland and its independence. So it's sort of a nod to Switzerland. And what we suggest is, just like Switzerland, every business should have independence. Independence from whom? Independence from customers. You shouldn't be overly reliant on any one customer. Independence from vendors. You shouldn't be overly reliant on any one vendor or any number of vendors. Or Switzerland, independence from your employees. You shouldn't be overly independent on any one or several employees. The more independence you can express and demonstrate, the more valuable your business is going to be. Valuation teeter-totter, somewhat connected to financial performance, but what it says is, or asks is, do you get your money on the front end or do you get it on the back end? Okay. Companies that receive more of their money on the front end are more valuable than ones that don't. So think about that. Recurring revenue models have more value than non-recurring revenue models. Some of you may be thinking like, well, my customers come back to me every day or every week or every month. Is that recurring revenue? No, that's not recurring revenue. That's what's called a reoccurring revenue. There's a difference. There's recurring revenue, there's reoccurring revenue. So even if your customers do come back to you every day, every month, every week, every year, what have you, and you can predict that, and that's fine, that's great. But if you think about it, each and every time they come back, you have to kind of resell them on your services, or at the very minimum, if something were to happen, it's nothing for them to just not come anymore. Whereas recurring revenue is a little bit more difficult to detach yourself from. And there are different types of recurring revenue models, and we'll get into those into later webinars that we do. But recurring revenue is a very powerful thing to consider. And we suggest is that there's not any business that can't have a recurring revenue model. I don't care what business you're in, you can have a recurring revenue model, and you should contemplate that and figure that out for yourself, and at least have a portion of your business have a recurring revenue model, because it will skyrocket your valuation. Okay. Growth potential basically answers the questions of how strong is your sales and marketing apparatus, and how solid is your marketplace. Because some of you are in expanding markets, some of you are in declining markets. It's helpful for you to know which one you're in. It's not a deal breaker if you're in a declining market, but you want to know that, and likewise have built up safeguards and mechanisms to guard against that growth. But it also is, how strong is your sales and marketing apparatus? Whether you're in a growing market or a declining market, you still need to have a strong sales and marketing apparatus in order to have your deal flow or your lead flow be predictable. And there's a whole world to that we'd love to get into with you. Net promoter score. How satisfied are your customers with you? That's a very, very important question to be asking. Most small business owners that we know or meet kind of shrug their shoulders like, oh yeah, we do well. We get good reviews, or every now and again we'll meet somebody who has a number of really great Google reviews online. But it's deeper than that. We have to build a system to consistently, deliberately generate customer feedback, and to categorize that and to ask that in a certain kind of a way, because more demonstrated client customer feedback equates to a much, much, much more valuable business. Okay. And then there's hub and spoke. We're going to spend a lot of time on this today. Hub and spoke, all of these I would say are critically important. If there's one that had to be more critically important than the others, it's this one. It's hub and spoke. Ultimately, this is what most, if not all, small business owners deal with at the point. Consider this. The more valuable you are to your business, the less valuable your business is. I'm going to say that again. The more valuable you are to your business, the less valuable your business is. which means that if you are the hub of your business, which many of you are, everything has to go through you. Every time an employee has a question, every time there's a fire that needs to be put out, every time a vendor needs something, all of these various spokes that exist around your business all have to go through you. And if everything has to go through you, that means that you don't have a business. You have a job. And many of you have to deal with that cold hard fact if we're going to build anything that has value to it, and that your business is you, basically. And if something were to happen to you, then the business goes away. And it happens every day. And part of our coaching to our clients is that we have to begin to put mechanisms in place to have you have a systems run business. One of the things we say to our clients is that great businesses aren't necessarily run by great people. It's fine if you have great people, but that's not ultimately what makes for a great business. Great businesses are run by great systems. And if you have a great person, or if you have an average person, or even you have a poorly producing person, you have great systems, which ultimately allows for predictable results to be produced time and time again, whether you're there or not, whether they are there or not, whether people are performing or not. And you even have systems to let you know whether people are performing and whether you should keep people, promote people, let people go, what have you. That's all inside of the hub and spoke methodology. And these are the 8 key drivers of value. And what we suggest is that once you're aware of these drivers, we have a brilliant assessment that allows you to um, uh, assess yourself in each of these values. And we have an assessment called the Value Builder Score that not only will let you know how you rate in each of these areas as compared to your closest competitor, but also will help you to see your valuation. Will actually see what your business is worth right now. And with an adjustment in your scores and your metrics, what that business would be worth if you were to tweak this, that, or the other thing. So that's a little for the 8 key drivers of value. And Abdullah, if you wouldn't mind terribly, just queue up and just copy and paste somewhere the value builder link, so we can put that in the chat at a point. I'll let you know when to do that, and people can take that test. It takes about 10-15 minutes to do, but I promise you it'll be well worth your time to do it. Okay, so that's a brief summary of the 8 key drivers. So let me just go back and offer an example. And so, just for example, if Stephanie in our last case study had mind her score on Monopoly of Control. So Monopoly of Control is a score. It's not a concept. So just like we were talking about it, think of it like a cable package where you have to buy this huge package of channels, but you're only interested in a couple of channels. And so what we want is for you to zero in on the channels that you want. Only deal with the channels that you are interested in. That's going to give you the most bang for your buck. And in working with us, we really work to get at that. And once you're able to get at that and improve those areas, then we can begin to connect the dots between, okay, here's what the business is worth. Here are the specific changes that we're going to make. And likewise, here's the value that produces in your actual business. So that said, let's talk a little for what this looks like, because we did some surveys and we really got at does this program really work? So the Value Builder team of advisors have really been engaged in not just the work itself and coaching our clients to these various effects, but we've also been tracking our statistics and really looked at, well, is this really working for people? So when we first start to work with folks, we find that the average value builder score is 3.5 value builder score. Okay. And let me just back up a step. So let me just say a little bit more about the study itself. So we studied more than 55 business owners who have used our system and found that the average value builder score is a 59. And those average businesses receive acquisition offers of 3.5 times their pre-tax profits. Okay. Now, as you can see from this chart, those businesses who achieve a score of 90 or greater are getting offers of 7.1 times. Okay, so the pre-tax profit more than double the average performing business. So working on these 8 factors, like I'm talking about, it's not just a theory. It's it's going to have a material impact on the value of business. And not only that, but it's also going to have a material likelihood on you actually getting an offer. So many of y'all may know that in the process, in the world of mergers and acquisitions and business intermediary work and businesses buying and selling, less than 20% of businesses that actually list themselves for sale actually sell. So for companies that we studied, the average offer is 3.5 times earnings. But for businesses that work with us and work from the 8 key drivers, get more than double that in terms of not just offers, but in terms of value for those offers. So the question becomes, okay, how do I get there? How do I get to a score of 90? And because, by the way, the value builder score is, in each category, it's on a scale of 0 to 100. And most people average about a 59. Okay, and in the process of working us, our goal is to get you up to at least an 80, preferably a 90. But getting to a score of 90 also means you're almost three times more likely to, like I said, receive an unsolicited written offer for your business. Like, you won't even offer to sell. Somebody's going to come along and just offer to you. So now you might be saying, well, I don't want to sell. Fair enough, like we talked about before. But getting an unsolicited offer puts you in the catbird seat, which is, again, what I want for all of you. I want you to be in control, and I want you to be able to turn down offers. I want you to be able to say you're not interested, or just to engage, just to see what the lay of the land is, see what the value is. I want you to have those options available to you, and you can always say no. So there's nothing that's more valuable. There's nothing that has you be more in control than or having more leverage and being courted by these offers. And this slide gives you an indication of what that actually looks like. So for those of us who have 90 plus, those in our client community who have 90 plus scores have received unsolicited offers to the tune of 20% more than they would have gotten otherwise. Okay. So let's talk about this concept that we discussed called the manager metric versus the owner metric. Because I think a lot of us as entrepreneurs, we make the mistake of thinking like managers. We make the mistake of not doing what the savviest entrepreneurs do, which is to start thinking more like owners. But the question becomes, well, what does that look like? What does that mean? So we as bookkeepers and accountants will be the first ones to tell you that when you look at this document here, many of you all will know this is a profit and loss statement. Okay. This, everybody, is a manager's document. If you're not accustomed to looking at this, I invite you to get familiar with it. Even though I'm calling it a manager's document, you still need to know what it is, what it means. But I want you to consider that every number on this page should be managed by someone not named you. Now, should you be aware of it? Of course you should. But there should be somebody, for example, accountable for advertising. There should be somebody accountable for delivery and freight. There should be somebody accountable for managing your assets. That's where the depreciation comes in. And there should be somebody accountable for your administration, who's keeping track of your insurance. There should be somebody accountable for your internal finance, which is managing the bank loan payments that you're making, the interest payments that you're paying. And so these are all. So when you look at a P&L, I want to have you look at it a little differently and start to really examine it, not just from the standpoint of, oh, I want to get my expenses down, I want to get my revenue up. But I want you to look at it in terms of, if I had managers, if I had a leadership team of people who were accountable for each and every one of these numbers, like these numbers were connected to their performance, what would that be like? What would that look like? How could I do that? How could I bridge the gap? Because Omari's saying to me that this P&L, these numbers that are showing up in the P&L, these are all manager metrics. They're not owner's metrics. So what are the owner's metrics? All right, hang on. Here's what I want to suggest to you. Owners think like cooks. Let me say it that way. Or I'm sorry, managers think like cooks. Like they just follow a recipe and they put it together. But owners think like chefs. Let's think for a moment how managers think. Managers, the typical manager, you went to school, they went to high school, they went to university, they learned about the language of management, and then they worked for a company. And then as a manager of that company, they rose through the ranks, they started to manage certain metrics. So if you think about that profit and loss statement that we were looking at, the sales manager focuses on revenue, the marketing manager focuses on advertising, and so on. But as an owner, what you really care about isn't those individual ingredients. All that stuff is fine. Those things are things that people are specifically trained to do and think about. What you care about as the owner is not so much what the ingredients are, like following a recipe. You care more about what those ingredients make. Okay. You care about the ultimate meal. So let's just look at that for a second. So remember, like we talked about, we're going to talk about value. And there are three fundamental components. There's profit, like we discussed before, there's multiple, and then there's your value. Okay. So the profit, let's say in this example, is $800,000. And multiple, like we talked about, on average is like 3.5 times. So if you have an $800,000 profiting business, what you're interested in as an owner is this value equation, this $2.8 million in value. Now, what happens if we can increase that profit at the same multiple? Okay, we go from 2.8 million to 3.1 million. Okay, so far, so good. But let's just imagine for a second that we take that same $800,000, but we can find a way to increase the multiple. Now, that same $800,000 goes to $5.6 million, more than double what that initial scenario would have given us. And let's do the same thing for the $900,000 at a 7.1 million multiple. We go from $3.1 million in the above example to $6.4 million in the second example. So what we're interested in, what we invite you to be interested in as an owner, is not so much the profit. Yes, you have to be aware of the profit and you want to drive profit. And that's a very important thing. But what we want you to be just as, if not more, interested in is the multiple, because that's where the real jumps in your value are ultimately going to come from. So how do you get there? How do you get at that? Again, we look at what are those drivers? Where are you weak? Where are you lacking? Where are there actions that you know to take that you haven't yet taken? And we really want to really begin to get at that. Like I mentioned to you before, the biggest challenge, hurdle that we find for the many of our clients is hub and spoke. Most of our clients are too wrapped up in the business and haven't found a way to effectively scale. So we see that the average multiple. So one of the things that we looked at is when the owner controls the relationship, because this is the case with most owners. They control most of the client relationships. And we looked at those offers that owners received that had a large percentage of, or that had higher or lower rather, hub and spoke scores than what would have been typical, would have been considered ideal. All right. So we took an average multiple of 3.76. And so we asked our overall client base, okay, how many of you know each of the customer by name? That took the multiple down from 3.76 to 2.92. And you can just see how the numbers bear out. I know most of my customers by first name, and they usually don't want to deal with anyone with me. They usually want to deal with me rather than any of my employees. Okay, 3.41 multiple, still less than ideal. I know some of my customers by first name, multiple goes up to 3.95. I don't know my customers personally and rarely get involved in serving any individual customers. Average multiple goes from 3.76 to 4.54. Big deal, big difference in valuation based on how our respondents responded to this survey. Okay, so what are the signs? What are the signs that you're in the owner's trap? One, you're the primary salesperson. Okay, and just look for yourself at what, not just what the diagnosis is, but likewise what you could begin to think about or do to begin to break free of the owner's trap. What are some of the other signs? We offer too many products or services. Okay, We'll get into this a little later in different modules, but one of the things that I want to offer you is that um, if you want to scale and if you want to break free of the owner's trap and you want to build a model that's simple and easy to duplicate, uh, you'll have to narrow your offering a bit and offer and be willing to tell some clients no. But that being willing to sell people no, kind of like that Stephanie Breedlove example earlier, will actually make you more money in the end because you become a real master and it becomes easier and easier to scale your operation than if you have way too many products. Okay. And certainly, if you're the only one that can offer certain services, that will diminish your value. And as strange as it may sound, if you have a direct, immediate, consistent interface with your customer, those are all signs that you are in the owner trap. Here's what happens. And just look for yourself. Does the business slow when you're away or stop completely? Do customers go to you directly when something goes wrong? And do you hit revenue platforms frequently? So how do you improve? How do you break free of the trap? First thing is just take a look at your current offering. How many different things are you offering to a few customers? And then ask yourself, well, what's one thing? What's one thing that I can offer to lots of customers? Because the more you offer to a few customers, trying to be everything to everybody, consider Pareto's principle, the 80-20 rule. What's one thing that I could offer to a lot of people and greatly expand my reach and likewise greatly scale my operation? Okay. All right. So I just invite you to consider that for yourself. All right. Let's get in. So we talked about hub and spoke. Let's talk about customer score. There's a guy named Fred Reichheld. He's a former advisory partner for a company called Bain. He invented a really brilliant mechanism that's gained quite a bit of traction in the business intermediary space, but large scale business as a whole. I invite you to Google it when you get a chance. It's called the Net Promoter Score. And what it does basically is it has you tally up the number of promoters. So it asks a really simple but very powerful question. So ultimately, Reichheld, what he did, it was he engaged in a study with Bain, and he examined the power and the effectiveness of surveys. And what he found was that one simple question got way more results than any other set of questions that had been being asked at that particular point in time in the study. And the question was this: it was a very simple but powerful question. It asked the question, on a scale of 1 to 10, how likely would you be to refer us, recommend us, suggest us to a friend or a family member on a scale of 1 to 10? And it's a very powerful, simple question to ask. And what he came up with, just as profound as the question itself, was how to begin to measure it. And that's what we're getting into right now. So what he said was, okay, out of every, 10, 100 respondents that you get, you take the number of promoters. These are the people that rank you and 8 or higher. And then take the number of passives, which are the people who are, 9 or 10 are the promoters. The passives are 7s or 8s. Anything below 6, 0 to 6, is what's called a detractor. Okay. And you take those numbers, and your net promoter score is going to be the difference between your percentage promoters and your percentage distractors. So you're going to get this score of a 20% in this case, your net promoter score. And that's a gauge. And you'll be able to compare this score with other folks in your industry, with the business world at large. You're considered to be, next level if your average net promoter score is above an 80 or a 90, like world class. You definitely want to keep it above 70, but wherever it is, it's going to be a very powerful data point for where you are right now in terms of satisfying your customers. Your customers are always, always, always going to be your best marketing support, your best marketing research tool. But it's incredible how so many businesses, even ones that are making millions and millions of dollars, aren't really doing the work and aren't really doing the thinking or up to date with how it is that customer satisfaction is being organized, is being asked about, and likewise being used in order to push their businesses to the next level. And there's just lots of work out there and commentary about what it is that has um, uh, 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 tracking your net promoter score and your client satisfaction or lack thereof be so critical in the development of your business. Okay. So let's get into the next driver, growth potential. So why do we care about growth potential? So when you think of an acquirer for a second, most entrepreneurs, we think of the end, the exit, is sort of like the last mile of a marathon. You can just get uh, your body across the finish line. But if you put yourself in the shoes of an acquirer, that's the start for them. So you're at the end, right? Just getting yourself over that last mile. With the acquirer, this is the beginning for them. So they're going to buy your business for, say, $1 million, $10 million, $100 million. And it doesn't matter, but that's their starting point. And what they want to know is that your company has legs, that it can grow quickly beyond what it's achieved. And when we're looking in the rear view, they're looking ahead and into the future, and we have to see what it is that they're looking at and the lens through which they're looking in order to make sense of whatever it is that's going to make a good offer or an agreeable offer for the both of you. So the question becomes, how can I take this business, and for them at least, for what I'm buying it for, and actually make a return? So that said, what you want to consider is that no matter how much they paid to acquire your business, they want to know how it can grow beyond what you've achieved and how you can make that return. And that's basically the set of questions that growth potential answers. How can I take what you've built and grow it into something else that the next buyer would be able to invest in and contribute to? Okay. Here's a question. If you had 5 times more demand for your product or service, just imagine you just wake up one morning and all of a sudden you have 5 times more customers than what you have right now. Want to buy from you? How easy or difficult would it be to fulfill that demand? So remember, the average multiple that business owners get is about 3.76 times. Now, for those businesses that say it would be impossible to accommodate 5 times more demand, such as a legal firm or something like that, or even an accounting firm, they received a much lower um, multiple, 2.94. Now, that's compared to those businesses owners that said that it would be very easy to accommodate, such as software and manufacturing. They generate much greater multiples. So this is inside of growth potential. You want to examine this to see, okay, it's not just sales and marketing, it's also capacity. Okay. And really start to answer that question for yourself. If I got 5 times more business today than what I had before, what would that provide? Now, here's Rod Drury. He founded Aftermail in 2004. And the whole goal of Aftermail was to provide a better way for companies to store old emails. So he sold 2 contracts to 2 Fortune 500 companies, and he generated $2 million in revenue. Pretty good, right? But Rod didn't look for more companies to sell to, but instead he went to look for the care.com, like we were talking about with Stephanie, of the industry. And he found this company called Quest. So Quest is a software reseller of sorts, and they have relationships with all of the Fortune 500 companies, and they sell software to them. So instead of competing with Quest, Rod brought up the idea for them to buy his company. And after just 2 years in business, just 2 years, and he only had $2 million in annual revenue from 2 customers, Aftermail acquired Quest for $35 million. Just think about that for a second. Rod made a case about the growth potential of his company to Quest. And now Rod's company was valued at more than 17 times what he was getting in annual revenue in order to get that. So again, think about what that could mean for you and what the real growth potential of your company is or could be. So let's talk about recurring revenue. When entrepreneurs think of recurring revenue, they think of SaaS companies, technology companies, software as a service companies, media companies, membership websites. And for most businesses, business owners, they think recurring revenue doesn't apply because they might be a retail business or a manufacturing business or distribution company. So with that, I want to talk to you about Sanu and Brian. So Sanu and Brian are the founders of H Bloom. And H Bloom started as a retail business selling flowers. So if you know anything about the flower business has two big seasons, Easter and Mother's Day, and where they pretty much sell more than 30% of their business. Not only that, but the average sale in a flower business is $29 versus $4,500 in H Bloom's business. How did they accomplish that? So what H Bloom did is they, instead of attempting to compete with your average tried and true flower shop, they said, look, we're going to take a page out of Stephanie Breedlove's book, and we're going to only promote ourselves to hotels, 5-star hotels, because 5-star hotels find it very important to have fresh flowers every day. And so they develop contracts and recurring revenue models and subscriptions for high-end hotels where they pay a set fee and they get delivered fresh flowers every day. And the average sale of $2,900 went to $4,500. And the, let me see if I'm not missing anything here. So yeah, so look, you may not have inventory, you may not have products that rot, but having employees as a form of inventory, recurring revenue subscription plans help for you to plan resources more effectively. So it's just really something to think about as you go. Consider a security company. Yeah, $750,000 for 100% installation. But what would happen if you actually opened up another portion for monitoring, not just the installation of a security device, but for monitoring? This is an example of another client of ours that we've worked with. All right, so what should you know? What are the things that you should take away from this? Number one, industry and revenue are important, but they're not the only things. Number two, focus on selling less stuff to more people. The riches are in the niches. Build a deep moat around your castle. That way, when you become the specialist, you become the best at what you do, better than anybody else who's in your particular category. Nobody else will be able to compete with you, no matter how much money they invest. Number three, reduce resilience on any single customer. Any customer that can only work with you is not a great customer for you. Okay. Or you haven't built out your systems well enough such that it's duplicatable. Number four, reduce reliance on any single employee. The best businesses aren't run by the best people. The best businesses are run by the best processes. And when you have processes, any person, or just about any person, not a bad person, but any average person can come and manage a really great, well put together system. Reduce reliance on any single supplier. Same rules apply. Diversify your vendor base. Always leave yourself options. If you have one supplier, you're placing all your bets on that one company. And if something happens with them, then your business is shot. 50% plus net promoter score. Okay. Even if you have a low promoter score, not the end of the world, but at least you know where you are and you're asking the question. And even if you're high, you don't want to rest on your laurels and get too satisfied with that. Always, always, always be looking for what it takes to build yourself up into that 9, 10 average space, because your customers are always going to be your best sounding boards in terms of what's working and what's not working. Number 7, leave some field left to plow. Have a plan to grow. Leave room for a potential acquirer. Again, I don't care who it is, whether it's your kids, whether it's your employees, your staff, whether it's the next CEO who wants to take to the next level, a financial buyer, a strategic buyer, but start to think about what the real growth potential of your company is. And that's going to give you some powerful insights into what's going to be next when and if you do exit. Lastly, create a recurring revenue stream. There is no business that does not have an opportunity to create a recurring revenue stream. The differences in valuations are tremendous with respect to what a recurring revenue model provides versus not. So that said, you guys, thank you so much. That's the end of our webinar. If any of you have any questions, feel free to put it in the chat. I'm going to stick around for a little while to answer any of those questions. If you want to stick around to hear those, then you're more than welcome to. I invite you all to, if you haven't already, Abdullah is going to put a link in the chat for the Value Builder Score. Please take your Value Builder Score, and you will not regret having done so. If you have any questions about that, I'd highly, highly, highly encourage you to reach out to us, and we'd love to hear you, to hear your questions and hear your thoughts and help you along in accomplishing the value that that you most look to achieve. Our next event, our next webinar, is going to be next month. It's always going to be the third Tuesday of every month. So the next one for us is going to be May. Well, actually, it's going to be, well, no. The next webinar that we're going to have is going to be on May the 13th. So not quite a month from now. This is one that's designed for other advisors, financial advisors, business brokers, insurance agents. You're more than welcome to come because the conversation is going to be really robust. But we'll announce the other webinar for May shortly. We'll send out an email about that shortly. So save the date on that. But again, I said third Tuesday of every month. It's the last Tuesday of every month are our webinars. Also, you'll see a link in the chat for our free ebook, 8 Key Drivers. So if you want to study some more on the 8 Key Drivers and find out a little better for how they appeal to you, click that link, the free ebook. I'd love to gather your thoughts on our ebook as well. We also do lives every week, LinkedIn lives every week. This coming Thursday, May the 1st, we are talking about hub and spoke. We're delving deeply into hub and spoke. And next Thursday on May the 8th, we're diving more deeply into how to develop niches. Remember, the riches are in the niches. So we're going to delve more deeply into how to zero in on that vital 80% or 20% that's producing 80% of your results inside of your business. And we certainly welcome your ideas. I'm going to share with you some thoughts on how to engage there. So anybody has questions, again, I'm going to stick around for a little bit to entertain any questions. All right. So if not, I'll bid you all adieu. Again, my name is Omari Kamal, Certified Value Builder, Profit First Professional, and I look forward to working with any of you all that we might be able to help. But if we connect anytime soon or not, feel free to check us out on LinkedIn. Check us out on all of our social media channels. Certainly look us up on profitandgrowth.com. And we're looking forward to engaging with you. We're engaged in a mission. We have a sort of an internal rallying cry. We're out to create 100,000 entrepreneurs with valuations of $10 million or greater. That's $1 trillion in value that we're looking to create in the next 100,000. Well, not really 10, but 100,000 at 10 million valuations in the next 10 years. So we invite you to join us in that movement. We invite you to imagine what would be available if $1 trillion in value was injected into the urban center, New York, Chicago, LA, Houston, Dallas, Atlanta, Detroit. What would happen if small business owners assumed a leadership position in the world and began to combine and share resources with respect to how to effectively grow and build their own business 401ks, business case, if you will. And we look forward to being a part of that journey with you. So wish you all the very, very best. Thank you for joining us. And we'll see you all either next Thursday on our LinkedIn Live, every Thursday on LinkedIn Live, or in our next webinar on the last Tuesday of next month. Okay. So thanks. Be well, everybody. We'll talk soon.